Well, the latest edition of the tri-annual Finweek Supplement Collective Insight is out with the magazine this week, and at this time South Africa's top thinkers are looking at the question of investment fees and what you as the consumer should be paying for them. Joining us now at the desk, Tandisizwe Mahlutshana, Finweek Deputy Editor, and Cabot-Alletzhauser, Head of Alexander Forbes Research Institute, and Steve Price, CIO at Investment Solutions. Thanks for joining us. And I think I'll start off with you. Just give us a broad overview of, I suppose, not some of the key findings, because that could take us all day, but some of the key takeaways in terms of what's driving this debate right now.
Well, National Treasury, simple. I think probably the most awaited paper out of National Treasury is one that basically argues, are we charging investors too much money? And we thought that what we would do this time is maybe preempt the discussion. As you know, Collective Insight tries to go out to the industry and say, well, what do you think? And I think that's what you'll see in the publication. You'll see all different aspects of the value chain standing up and saying, here's where I think the value is, here's where I think the cost is, here's where things are completely out of line. Mm-hmm. And that's really what the gist of the publication is.
Mm-hmm. So is it the fact that you've got alternatives that are also delivering when it comes to returns? I'm talking about ETFs and passive investment options.
Yeah, well, I think it's all tied back into what you as an investor are trying to achieve. So it's all looking about what your risk tolerance is, whether you believe in active versus passive management. If you're an inherent believer that the best thing you can do is just get the asset allocation decision right, then you're probably going to tend maybe going towards passive investments. If you believe managers can add value, you go for active. So there's a whole spectrum where investors can slot in terms of the product or portfolio that they buy. That can determine, philosophically where they will align themselves with the fee debate. Mm-hmm. And really, fees for most, large employee benefit or large pension funds, asset management fees, I'm talking, can be anywhere from 20 basis points or 0.2% right the way up to, 3 or 4% if you go into some higher risk, more niche type asset classes where performance fees become a factor as well.
Mm-hmm. Blunt question, but has the industry actually changed its approach to fees? Because there was very much an outsider's view that the industry was simply finding ways to build in fees. But then we actually start talking to a lot of the guys within the industry themselves. You can see that a lot of people have actually been quite active in terms of whether it's simple things like your TRs on your unit trusts, platform fees, they are coming down. Obviously it's a scale issue that plays quite a big part there. But just honest and bluntly, has the industry done enough to bring down the fees within the value chain?
Well, the way I look at it, I would tend to argue no. I think a lot of the work that the industry has done is slowly lowering fees. Mm. But if you have a look at it, a man on the street buying a unit trust through a 1,000 Rand a month debit order could still end up paying anywhere up to 3 to 3.5% per annum for the pleasure of his savings product. And with inflation running at 5.5–6%, he's literally got to get a return of 9 or 10% before he's actually generating any type of real return. Now those have come down because we have seen the industry do away with a lot of fees like upfront commissions, initial admin fees. Those are all things of the past now, and fees in general are coming down, and the industry will take time to adjust. We've got 45 or 50 years of history in the unit trust industry now, and legacy that has to slowly readjust itself to global best practice and market forces.
Now, when this debate of fees came about years ago, many investment professionals who at the time would have worked or been working for some of the big investment firms and maybe insurance companies went on their own and really started small shops on the side, and when they approach the market, with really, really low fees. Now, how does that impact in terms of funds moving around, and how does now that put pressure on the big guys in terms of lowering fees?
Well, that is just a pure function of capital market forces. There are always going to be new entrants coming into the market. Investment professionals build up good track records at existing asset managers, and back particularly in the late 90s, early 2000s, we saw a lot of boutique managers coming into play. And I think the way that a lot of the industry has tried to adapt to that or stop that particular thing happening is that you've seen a lot of the life companies go the boutique model, where they're telling the investment professionals, you don't need to leave and go and set up your own company. because we'll offer you a small portion of the equity or the profit in a smaller niche business within our broader life company, and that's very attractive to a lot of investment professionals because they get all the benefits of a compliance infrastructure, and compliance is becoming regulation and dealing with that's becoming a major issue, and if you can plug into an infrastructure, well, I think that's a very attractive.
I think one of the issues, though, is that, I think your own research says you need 2 billion in assets under management just to be a credible small asset manager. You go and you land at O Tambo or Cape Town International Airport, and it's plugged with all the big name asset managers, those that can afford TV commercials, etc. And people become so used to supporting the same. How does the small guy get their foot in and therefore impact the value chain?
What are your thoughts, Anne?
Well, are we talking about fees now or survival? Because I think...
Aren't they linked?
Yeah, I mean, I'd argue they're linked.
I think, your big problem in this whole debate is where is the consumer? And one of the most interesting things that happened in the wake of the crash, 2008, the Financial Times came out with an article that said, of all industries, asset management has less consumer advocacy than you would imagine. And much of it is because of this whole asymmetrical information thing. Now, what do we mean about that? There's an awful lot that I understand about investing because I'm a professional. I know how much skill can translate into performance, and I know how little that is. But if I tell you all those little secrets, will you pay me still? And the irony is the investor will pay you because they want to believe. They want to believe that you can deliver the goods. I don't mean you, Steve, but your team. And so, in a sense, you have this friction that you have asymmetrical information. You don't really know what's driving performance. You don't really know to what extent can I give the manager credit. But you've also got someone who's refusing to take the money off the table because they say, but please, I want to win.
Fair enough. So then let's go and talk about the role of the advisor in that as well, because a lot of the advisors tend to go and support the same, they buy exactly the same argument, surely.
Well, they also want to make their job easy,
yes,
right? And how do you make your job easy? Well, let's see, who's got the billboard up in the Cape Town office, Cape Town Airport, and I don't have to sell twice. And that was the dilemma that a lot of small asset managers faced. First, they had to sell their credibility as small asset managers as being able to survive. And then they had to sell whether or not they were, investment experts.
Let's talk about performance fees and the debate, the discussion that is going on, how much you should charge for performance. Where do you stand in the argument right now?
Yeah, so we are advocates of performance fees. So we believe they have a very important role to play in crafting an overall remuneration structure for an asset manager. What we are very much against is the way that the industry has total flexibility in terms of the way it structures performance fees. So there's no standard calculation methodology. There's no standard way of setting what benchmarks can be used. So you can find often an equity portfolio earning a performance fee over whether it beats cash. Now, I can tell you that the worst asset manager in South Africa has beaten cash if he's got an equity mandate over the last 2 years.
Africa funds.
Africa funds
are trying to beat
I know
LIBOR.
we've had this discussion so many times. Roland Rousseau, who's on Wealth Quest with me, Mr. Benchmark, he always talks about the fact whether a benchmark is appropriate. And it comes up, particularly in Africa, it's a big problem. It comes up for a lot of funds, and if you are using a certain benchmark, it's not appropriate, then, performance fees aren't appropriate there.
In performance fees, it just goes so much further than the benchmark, though. It's not only the benchmark, it's whether you use a rolling 12-month measurement period or from inception. In rolling 12 months, all you've got to do is keep your client's money for 12 months and any underperformance gets forgiven and you can start earning performance fees again. Then there's the issues about should there be a hurdle above a benchmark. So surely asset managers should at least cover the fixed portion of the fee that they're charging before they start earning a performance fee. Another element would be this whole issue around what participation rates. 10% of outperformance, 20%. What is a fair participation rate for the performance that you generate? And these come in multiple different combinations with multiple different subtleties. And I would argue that only very few asset consultants, multi-managers, and some of the larger sophisticated clients actually have a good handle on exactly what performance fee arrangements they have in place with the asset managers. And when you're buying into a pooled fund, you have no say whatsoever over the performance fee methodology. You're a performance fee taker from the asset manager. At least when you have a segregated mandate or a large mandate, if you've got a clever asset consultant or a multi-manager who's negotiating on your behalf, you can put in place things like high watermarks and some of these mechanisms to protect you.
Mm-hmm.
I think as an investor, one of the things that are most confusing, especially when you want to, invest in certain funds, is that you can look at two equity funds managed by two different asset managers or fund managers. But they charge very different performance-based fees. But if you look at the performance, it's pretty much on par and in line with
Correct.
one another. And you speak about standardization of fees. Would that be an idea that Treasury should be considering for this upcoming paper?
So the unit trust industry has gone halfway in that they have certain disclosures that need to be made around the performance fees that are earned. But I think that is probably the logical next step that's coming, and I don't know whether it's now or 2 years or 5 years, but is to move towards a more standardized way of actually regulating performance fees, especially because they often, and one of the big issues that the Treasury I'm sure will have in this upcoming paper is this whole issue about hidden fees. And a lot of times performance fees are just taken out of the unit price. Nowhere on your statement do you see a rand deduction for the performance fees that you've paid. It just comes through in a lower performance. And I think that I wouldn't be surprised if at some point we do see the Treasury or industry moving towards a set of guidelines around how performance fees can be earned.
And
you can standardize up the wazoo. You still have a huge problem, and that is your starting point. Is benchmark meaningful? Is a benchmark? What are you paying for in a performance fees? Well, in the investor's mind, you think you're paying for skill. But if the benchmark, as Roland
you're paying
said,
for outperformance.
you're paying for outperformance. And I think I've mentioned before, at least I have in this article, that one of the great travesties of our industry is our starting point was assuming that the only value we add as asset managers is outperformance of some benchmark. But in fact, what a fund manager does, if he does it right, is a huge value if he can just keep the trust of the investor. If they can keep the investor believing that there's a steady hand on the tiller when the storms get rocky. Because where the value destruction is in the chopping and churning and people chasing the performance. And that's the real travesty. So we pay for performance as though it's some sort of nirvana. We force an industry to go and chase that performance and destroy value hand over fist. Whereas if we just paid the advisor on the basis of being good, credible, trustworthy, and
How
clear.
can performance also be linked to managing risk? Because some would argue
that's
that
another
it's also about that managing risk is perhaps more important than outperformance.
Well, that's a good question for a multi-manager, because that's what they do.
Correct, absolutely. So there are a few things when it comes to aligning performance fees with risk management. The one thing that you always want to do, or that we advocate, is always capping a performance fee that you pay to an asset manager, because you don't ever want to be in the position where you incentivize somebody to take undue risk with your assets in pursuit of fees. People need to know that above a certain performance they will no longer get remunerated, and I think that stops that type of behavior. As a multi-manager, where we are out there selling and promising and hoping to deliver to our clients a risk-adjusted return, we don't earn any performance fees on our arrangements whatsoever. And we feel that aligns the mandate that we have with clients in terms of not only managing an investment return outcome, but also managing an investment risk outcome.
What about regulation? Because the argument the industry will turn around and say there's far more risk actually managing these products now as a case of processing, various committee meetings, documentation, compliance, drives up the overall cost. Is that going to be? Is the industry going to push back on that front and basically say, we justify our costs because you've put more legislation on top of us?
I have quite a strong view on that one. Overall, you would expect asset prices to increase over time. And so long as the industry is earning fees that are based on a percentage of assets under management, you effectively got a natural built-in inflation in the fees that you're earning, and that should cover the additional costs of a lot of regulation, etc. Now, in the UK, in the US, they've got 3 or 4 times the amount of regulation that we have, and they seem to cope. And I think the South African industry needs to do similarly.
Are South Africans paying too much, right? And this goes back to the question we asked at the beginning: too much for asset management right now, or is it varied across the board?
In terms of what they're getting back, yes, and there's been some very. If we're only talking about that outperformance game, if that's what your value is, then we're paying too much. If you look, and maybe the issue is we've got to go back to first principles. What should we be paying for? And what does it cost for us to deliver what we want to pay for? And we haven't really, the industry has sort of been on autopilot for so many years that sort of assuming that whatever model we have for pricing is correct. I mean, maybe we really need to go back to basics and ask the question. And one of the things, I had a conversation with Steve beforehand about the asset under management model fee and how that was in any way justifiable. And it was explaining to me some really interesting things about how now, with all the capital adequacy requirements that are sitting on top of fund managers, that the more assets you get, the more costs you incur for covering your risks, your insurance, your capital adequacy.
So bigger is not necessarily better, scale.
Well, it's more expensive to run. So remember, when you said that $2 billion is all you need, that used to be the rule of thumb, but that's now changing because of all these new costs that have come on there. So now we maybe need to do what ASISA did with the umbrella funds and go back and ask the industry, what does it actually cost you to operate? What are you charging? How much of a gap is there? And
is the industry willing to divulge that? Because that must be tough. I mean, you were talking about remuneration. You want to keep top quality people in the industry. You don't want them looking at other options because it becomes less attractive.
Correct. So, I mean, my understanding, and we are represented on ASISA, and my understanding is that the industry has agreed to share any data that it has with the Treasury in terms of the overall fee review that's coming along. So I think the industry and ASISA and the various asset managers all have an aligned interest here, because it's all about sustainability at the end of the day. And if we get it wrong now, you just create further problems down the line. So I'm many people are fearful of the paper on that's about to be released on costs. I for one am feeling quite positive about it, because I think it actually long term makes for a better, healthier asset management industry, and as a multi-manager where our suppliers are actually the universal asset managers to pick out there, the more opportunity set that we have and the healthier that is over the long term, the better for us.